So the first index fund was created a little over 50 years ago in 1973. And that was a US equities index fund. And since then, the equity landscape has been transformed by the rise of investing and trading with indices. For the fixed income markets, it's a different and it's a later story. Whereas today, around half of all mutual fund assets are in index funds, that figure's only around a quarter for bonds-based investing. However, interestingly, the growth rate within the fixed income segment is actually higher, or has been higher over the last 10 years. So they're starting from a lower place, but they're growing faster. The rise of passive investing in equities has been a trend that has transformed an entire industry. The way that we invest today is fundamentally different, and the way that people trade today is fundamentally different. Those changes have not yet happened in the fixed income markets, but it does seem to be that we've reached an inflection point where the range and viability and availability of products in the fixed income markets echo those around the time that things really started to take off in the equity markets about 15 years ago. There are a lot of different ways that people use indices as part of an investing context. I think the most powerful aspect of index-based investing and trading is it brings together different market participants with different objectives. There may be investors with a very long-term horizon who are looking to passively track the whole market over a very long-term horizon. And they are interacting with high-frequency traders, active investors who are using indices. And it's this ecosystem of different market participants, some looking for lower cost, some looking for efficient access, and some looking for efficient ways to trade. That, if you like, is the secret sauce that has made indexing such a powerful tool for such a broad range of investors. So SPIVA is an acronym, stands for S&P Index versus Active, and it's the brand name for a series of reports that the index business has been producing now for over 20 years globally. Our first report was in the US and just focused on US equity. And since then, we've expanded the series to cover 9 global fund markets. Last year, we introduced fixed income coverage in the European markets. Just to give you a sense, one of the most commonly quoted statistics from the report is how many actively managed funds outperformed their assigned benchmark. In the fixed income markets, drilling down into euro-denominated funds, the underperformance rates for high yield, Euro corporates and Euro sovereigns was 76%, 83% and 91% respectively over the 10 years ending December 2023. Now, what those statistics tell you is, well, 2 things. First of all, it was hard to find an outperforming active manager over the long term. It also tells you that an index-based approach may not be settling for average. In fact, it may be delivering a performance that actually stacks up quite favorably compared to the alternatives. I think broadly speaking, we've got to acknowledge that every investment portfolio starts with an active decision around asset allocation, around priorities, around growth and risk management preferences. What I've seen happening is the industry is changing. Rather from really valuing individual security selection as the real value that an investment manager can provide, it's more about the toolkit that you have nowadays. In fixed income, taking control of where you are on duration, where you are on the credit spectrum, where you are in terms of currencies, and taking a more toolkit-based approach on broad segments. And what's enabled that is the existence, in many cases, of index-based tools, ETFs, futures, etc., that give active investors, and we are all active, an enhanced toolkit that allows us to take better control of our exposures and spend less time on those decisions that maybe aren't as valuable in terms of picking one bond versus another.